Good morning, everyone. Welcome to Office Zero 24/7. My name is Niharika Walia Bhatnagar, and I am with you with the era of ABFM. I hope I am audible as well as visible to you. Okay, all sorted. So let's begin with the class today. Today we'll be taking up the questions related to risk. Uh, okay. After the capital investment decision, we are looking forward towards this area. So let's begin with the first question. Acha, everyone, what do you mean by the term risk there? If I talk about the risk now, risk means it is related to the era of uncertainty. You know, in the businesses we face that. This is adjustment of risk and uncertainty in the capital budgeting decisions. See, when we're taking a decision, one problem that can occur is if I thought that I'll receive this much amount of money in my project. If I don't get that much money on my project, then it is too dangerous. Why? Because I had planned the entire repayment schedule, I had planned the entire further working of the projects based upon what are we getting in the early years. So if the early years don't go by the plan, then there's a major problem. So let's look at the questions. Certainty equivalent approach is guaranteed return from the investment after adjusting for certainty equivalent to coefficient return that is expected over the lifetime of the project equivalent to NPV or an important component of decision tree analysis. Decision tree talks about if this happens, this would be the repercussion, this happens and this would be the repercussion. They have all that particular thing defined. Certainty means this is something that we'll have. है ना? So in this case, the correct answer would be guaranteed. Return from an investment after adjusting for certainty equivalent coefficient. So here the correct answer would be A. Certainty means guaranteed. Acha everyone, the basic risk in the capital budgeting arises, as I told you, if my initial investment is of rupees 80,000 and the cash flows that I expected over the period of time is 1, 2, 3, 4, 5 years is 10,000, 15,000, 70, then let's take around, then we'll start making 50,000, then we'll make 60. So I'm expecting probably within the first 3 years, this 80,000 will be paid off and then we'll do something else. Roughly, you know? So if you're looking forward to this way and any of these years have a major deviation, this particular initial investment repayment will become unsure, will become uncertain, will become something which we don't even know about. This is where the companies will look forward towards guaranteed amounts. Okay, this is the area where we'll be getting the money in any case. There should not be any risk. Okay? Scenario analysis is considered under scenarios such as worst, base, best, or all. Worst is you're all said that the things can go really pathetically bad. Base is basically the average one we're looking at. If it turns out to be really good, that is the best one. Scenario talks about all of these. All the cases that can come up, and that is where they look forward towards the combating of each and every situation. So the answer is all of the above. Next question. It says sensitivity analysis. Acha, pata hai, when we talk about capital budgeting, we have many things that can be changed. Initial investment, cash flows, discounting factors. At least these three variables can be changed by anybody at any point of time. True or not, everyone? Done? Sensitivity means if any of these things change, what will happen to our course of action? Acha, there's one more, life of that particular project even. Think about it. If the life of the project is smaller or if it is longer, it will take a lot of time. The pressure on the company increases. Here it is taking a lot of time. We were thinking that we could recover the money in this much amount of time. Now we can't. What to do next? This is where the entire thing has to be analyzed. That this particular variable, if changes, it's going to hit us badly. That is called sensitivity analysis. Okay? It is useful in decision making because it shows the probability associated with each outcome. It tells the user how much critical each input is for the output. It allows to calculate the probable results under different scenarios, and the results of sensitivity are reliable. The results can vary. It is never based upon that. It is based upon the input that we are putting. If I put a particular data, it will give me the result. So sensitivity really doesn't say it's a reliable thing. It depends upon the reliability of your information, the estimations that you have made. But yeah, there's one thing true, that it will tell you how critical one particular thing is. If the initial investment changes, NPV changes. That's true, the NPV changes, but not very significantly. Cash flows, the cash flows, inflows and outflows, if the amount changes every single year, then that's a scary part. Discounting factor changing will also impact it. If the life of the project changes a lot, then this is one of the factors which will put a major dent to the organization. So in this case, I would go for B. Done. Moving on. When the risk is high, the cash flow under certain equivalent coefficient is. What will happen? Having a higher risk is always bad, but until or unless you are rewarded well. That's what I know. If you're rewarded well, then if you're rewarded well, ultimately you don't have a problem with the money. Even if it's a risk, you will go through the risk. But if you're not rewarded well, this will give you a bad feeling. So in this case, if the risk is high, the cash flow under certainty, there is nothing certain when the risk is high. It is lower. That's the correct answer. Risk arises from various sources such as market, competition, international, or all. The risk arises from all of these. Market risk is there because market fluctuations occur. Competition risk is there. Sometimes you are good, but your competition is better. Then international risk is related to dollars, then other different scenarios. For example, the summits have been happening, treaties have been signed, wars have been initiated. Anything can affect the working of your country or dealings of your country with, I'm sorry, with the other country. है ना? Anything can create a trouble then. So all of these. In terms of the international risk, we can also include the currency risk. Okay, when we are moving from one currency to another currency, the strength of one currency, appreciation of money, that is appreciation of domestic currency. or there can be a depreciation of domestic currency. Anything can happen, na? So it is all of the above. In the capital budgeting, risk refers to a possibility that the project will not generate the expected returns, variation, or total cost or initial investment. What would be the answer? In this case, the possibility that the project will not generate the expected returns. This is the major problem. What if the organization does not generate what they were thinking about? This is the most scary part for any organization because you rely on your data, and then on the basis of the data, if you are outperforming whatever you are doing, whatever your expectations were, you are performing better than that. That is good. But in case the organization is performing less than that, this is the scary part. Okay. Which method provides a range of possible outcomes of a project NPV, right? Which method provides a range of possible outcomes, not one, not two, but a range. Sensitivity, payback, certainty equivalent approach, or accounting rate of return. If you look forward towards the correct answer, see, when we're looking at a range of possible outcomes, if the worst, then this will happen. If in the best case, this will happen. Normally, this happens. What is it? Worst case, best case? We did it somewhere. Did we do it in sensitivity? No. Payback period, this is a part of capital budgeting methodologies. Then certainty equivalent approach. This is for these things will happen, or accounting rate of return, another traditional method of capital budgeting. So in this case, what's going to be the answer? The correct answer is going to be sensitivity. Acha, possible outcomes na. This is sensitivity only. I was looking forward to the scenario there. Since we look forward towards a range of outcomes na, what we do here is in terms of sensitivity, there's a cooler approach. If you go through it practically na, they specify sensitivity as in a particular capital budgeting question. So what are the things that are relevant? First is your initial investment, what you are spending. Say I spent rupees 50,000. Second thing is life of the project. Say I'll receive the money for the next 10 years. If there's a discounting factor, then discounting factor. Say 10%. Initial investment, life, discounting factor. Next thing that comes here is cash flows. Say I say rupees 20,000 per annum. 4 elements are given. If this element changes, the entire working will change. If this element changes, the entire working will change. With every single element, find a different NPV. And that NPV will help you to understand other things. This is the power of the sensitivity analysis, because we are going to study each and every variable individually, and we can also combine two variables because we need to find maximum outputs, that what can happen in what scenarios. So it can be any variable single, or you can take up two or more variables together. You can change them and find what would be the NPV. So in this case, the correct answer is sensitivity analysis. Okay. Next is, which of the following statements is true regarding risk and uncertainty in capital budgeting? Risk can be completely eliminated through proper analysis. Risk can never be completely eliminated. Even in terms of taking this particular class, risk can never be completely eliminated. Risks is always there, है ना? Risk never goes away. It can be mitigated, it can be reduced, it can be managed, but it is never gone. Uncertainty refers to a situation where all possible outcomes and their probabilities are known. No. Uncertainties occur when things are completely not known to you. We don't know about the future, do we? So I can say it is uncertain. The goal of risk management is to make uncertain cash flows comparable. We're going to compare all these things. So the goal of risk adjustment is to make uncertain cash flows comparable. It's not about making it comparable only, but yeah, to an extent this is also required, right? The goal of risk adjustment, we are going to adjust the risk. Yeah, this is what we can say. The last is adjustment of risk always results in a higher NPV. This one's completely wrong. चलिए ये तो clear है. First and second gone, and the last one says that will give a higher NPV. How do we know? When the market goes down, nothing goes up. No returns are defined there. That means this is wrong. The correct answer would be C there. This is elimination method. When you keep on looking at the options and you find all the options which are not setting up well, then you go for the one. The answer would be C. The goal of risk adjustment is to make uncertain cash flows comparable. Uncertain cash flows, a little certain, little closer to reality. Adjustments are done for that. But that makes it comparable to the standards as well. Na? If I set a standard ki nahi everyone, you should study for at least 12 hours a day. Can you do that right now? You spend more than 12 hours in your office and you have a family and you have a traveling work as well. You more or less, I think most of the bankers are working from at least 9 to 7. You know, at least 10 hours are gone in terms of the office. And if I tell you you study for 12 hours, acha, that's just 22 hours. All you need is 2 hours of sleep throughout the day and that's it. What kind of standard would it be? I have to look forward to the facts as well. That is why I was looking forward to this point. The term comparable makes the point as a dicey one. But since everything else makes a sense, so it is better. Among the following, which statements is not true? Opportunity cost of the input is considered as in capital budgeting. Capital budgeting decisions are reversible in nature. Can they be? बाकी तो समझ आता है. A point is sorted कि चलिए opportunity cost is the next best alternative use. If I would have opted for that, it would have been better. The cash flows and accounting profits are different. Yeah, they are. Because cash flows is the money that you get. Profits is something else. An expansion decision is capital decision. Yeah, if you're looking forward, if I had an output, let me give you an example there. If I had an output of 10,000 units, now I want to buy another machinery. We're looking forward to an expansion decision. Now we want to make at least 20,000 units. So I'm going to add another level of working. So in this case, the correct answer is irreversible. The capital budget decisions are never reversible. I can never say na ki bas I spent 20 lakhs and yeah, if I can just sell off this particular machinery, I'll be fine. That will never make a sense. Why? Because these major decisions are for years to come. So these are irreversible in nature. Once done, they are never reversed. At least for a longer period. Okay, what is the sequence for estimating the particular portion of capital budgeting decision? Cash flow, identify the discounting rate, project selection or determination of NPV. What would be the correct answer? In a capital budgeting, first is the last point always comes as project selection decision. You choose a particular project by the end. You're doing everything for that. So A is eliminated. है ना? First is then determination of NPV. Second last would be determination of NPV. So I have got one more. This is also eliminated. Now either you look at cash flow first or you look at discounting rate first. Where do you start from? You always start from your cash flows First of all, you get the cash flows and then you make the discounting of it and then you continue further. So in this case, the correct answer is B. Okay, everyone, this is the end of the particular session. I hope it was helpful for you. What you can do is you can take up our course for the CAIIB. For that, where you need to go is our website, that is www.adda247.com. As soon as you reach on the particular area of our website, you will find the courses under the head of JIB and CIB. So if I go on to the CIB area, exclusively you will find our current batches are going at double validity. Matlab, you take the batch there, which includes current batches, bilingual, English medium both, the batches which have ended already, the marathons which were available in the previous ones, along with that, all the ebooks, plus all the 5 electives, plus we have also covered the area of we've also covered the area of the doubt sessions, marathons and many mega marathons for this examination. Plus, we are also coming up with the area of practice papers so that you can practice for the last days as well. Along with this, all these things are added in the Mahapack 2.0. So if you're looking forward to it, the best time is today because double validity is going on. Use the code EXAM80 to get all these particular benefits, and plus if you get the CAIIB Mahapack, you don't have to buy the revision pack separately. Revision would be included in it. So if you're looking forward, then kindly hurry up and buy it as early as possible. So thank you so much everyone. I'll be meeting in the next class.